The Reserve Bank is expected to keep interest rates unchanged this week, but the prospect of further credit downgrades as well as political tension may influence the Monetary Policy Committee's next decision. Last week, Treasury, business and labour leaders met ratings agency Moody's. It's currently reviewing the country for its next rating. Some analysts expect the Policy Committee to keep interest rates steady while raising its inflation estimate slightly. Lower electricity and oil prices are expected to push inflation numbers, also due out this week, but lower. The committee meeting starts on Tuesday and a decision expected on Thursday. So we'll be keeping a close eye on the Reserve Bank's interest rates decision this week. Joining us in studio for this, we're joined by Economist at KPMG, Maura Feddersen. Maura, thanks so much for your time today. You know, when we started the year, we were talking about green shoots in the economy, the end of the hiking cycle, even possibilities of interest rate cuts towards the end of the year. But things have drastically changed, and I suppose that's the nature of what happens in the monetary policy space.
Thank you, Siki, and thank you to your viewers. Well, absolutely. Following the cabinet reshuffle, we saw that a number of credit downgrades happened, and initially the Reserve Bank came out to say it's too early to say what that means for interest rates, but there is of course a possibility that if the outcomes are higher inflation rates, that this could mean higher interest rates in months to come. However, it is too early to say whether this will be the outcome. At the moment, it seems that while the interest rate hiking cycle is probably over, it may not mean there's the beginning of a rate cutting cycle just yet.
When inflation targeting was introduced back in 2000, and we started to see the Reserve Bank becoming a lot more transparent in its decision making and telling us why they're taking certain decisions, what impact do you think that that's had on the behavior of consumers and businesses?
Well, there's a possibility that some of the price rigidities that we see in the economy could be softened. And that is certainly something that the Reserve Bank would like to achieve. The problem has been that inflation has been anchored at the upper end of the targeting range, more above 5%, rather than at 4.5% in the middle of the target range, where actually the Reserve Bank would like to see inflation. And those price rigidities have to do with the wage setting processes and, for example, energy prices. So what the Reserve Bank can try to do is that by convincing stakeholders that inflation is on a predetermined and muted path, that in fact wage increases, for example, should be inflation linked, and that is warranted. And so that is a continuous process where possibly over time that can be softened.
Putting inflation aside, one of the criticisms that the Reserve Bank and the MPC does come for is that focus on inflation, and many people have said, why don't we have a dual mandate, maybe one that looks at growth, maybe another one that looks at unemployment as well. What's your thinking on that?
Well, they're actually very diverging views in terms of the responsibility that monetary policy can take for changing a country's growth outcomes. But in the end, the South African Reserve Bank takes the view that it is through creating an economically stable system, for example, through keeping inflation in check so that there's a predictable purchasing power of what the rand can purchase in South Africa. And through that sense of stability, they aim to create an environment that is conducive for sustainable and balanced growth.
Yeah, and I think maybe just staying with that point, let's talk about the importance of that stability. And that certainty, and how that actually impacts on ordinary South Africans and their own purchasing power.
That's it. You could say that, imagine if you had unwarranted decreases in interest rates. The outcome could be a weaker exchange rate, higher inflation, and that raises the cost of living for all South Africans, and actually that disproportionately impacts the poor.
And ultimately that's the point.
That's exactly what you try to prevent. It's about easing the burden on the poor, and monetary policy is somewhat limited in terms of what it can do. There are, of course, theories around the fact that fiscal policy can be more impactful. That's why growth-enhancing spending programs, especially investment programs, are essential for raising South Africa's growth onto a higher trajectory.
And we're going to be talking about investment a little bit later on the program. Just staying with inflation, we're expecting CPI data out. Do you expect it to fall within the target band?
Yes, that's coming out on Wednesday. There has been a decelerating trend. So the peak was in December last year at 6.8. Then we've definitely seen a slowdown. In March, we were at 6.1. Just before that, February, 6.3. So it is quite possible. And in fact, the Reserve Bank has revised down their expectations for inflation this year at their previous MPC meeting from 6.2 to 5.9. So it's looking promising that this is possible.
Doesn't necessarily mean a rate cut, though, does it?
No, it's highly unlikely at the moment. The inflation outcomes are still really just reaching the upper end, and what the Reserve Bank would probably want to see is a more sustained return to within the target range. And of course, there's a bit of a wait and see attitude that I think they may be adopting because of some of the outcomes being expected around the local currency ratings.